Bismillahirrahmanirrahim. Assalamu alaikum. This is Dr. Muhammad Meraj, Department of Finance and Economics, Muhammad Ali Jinnah University, Karachi. This is our macroeconomics class. Today we're gonna major economic activity, or we study major economic activity, how to measure economic activity. Actually, I have told you earlier that the three basic objectives of macroeconomics. One is rapid economic growth. So, how you can measure the rapid economic growth? This is our concern. So, let's start. So, GDP or gross domestic product is one of the major we can use to measure the economic activity. This is the yardstick of an economy's performance, and this is part of national income product account of national account. To determine level of development, we use GDP per capita. If we consider GDP from the expenditure approach, so we have the sum of dollar value of consumption, investment, government expenditure, and net export. Mathematically, we can write GDP equal to consumption plus investment plus government expenditure plus net exports. So how to calculate GDP? We have two main objectives, two main uh, methods to calculate national product. One is good flow, so in which we check the final goods and services like number of change into price of change, then earning flow, and this is from the factor of production's earning or like wages, rents, interest, and profit. So this is the circular flow of GDP. We're focusing two main sector, household and firms, and two markets or the two main markets, factor markets and goods market. Actually, this is the simplest model, 2 into 2 model, where we are considering only two sector and two, you know, two markets. So, so the outer circle is kind of land labor capital. So the household provides factor of production to household provides factor of production to factor markets. Then these factor of markets are bought by firms, and firms produce goods and services. That is, goods and services are bought by household. In the inner flow, money comes from household to again. So this is circular flow, actually circular flow economic activity. So household buy goods and services. So their expenditure goes on goods and services to firms. The firms buy factor of production, and that again goes to household. So this is the economic coordination or um, circular flow of economic activities. Then the price is the main factor or the adjustment mechanism. That is the main factor here, which affects in both direction. So if we see the income statement of GDP, so it's a kind of, in the upper part, this is showing the income statement of a typical farm. So this is how we calculate GDP from a single farm to entire economy. So if you see, here is the sale of goods. So this is the simplest farm or agricultural farm, so producing corn and apples. So the value of that goods is $1,000. And on the other hand, to produce these goods, the farm owner actually he pays the money in wages, rents, interest, and his profit. So all in all, this 1,000 is earning, and these are the output. So So the same way we can check it in the entire economy. So the left hand side showing the output, or right hand side showing the earning. So this, the left hand side must be equal to the right hand side. This is the rule of income statement in accounting. So what is the problem in GDP? Actually, there might be a problem of double counting. So if we are considering wheat and then flour, then baked off, then the final product. So we have to check, or we have to subtract the value of intermediate products, because by definition GDP is the value of final goods and services produced within a country for any specified period. So to avoid double counting, we must take final product, or we can subtract the intermediate products. Then we studied nominal GDP versus real GDP. So the difference is, nominal GDP is, you know when we calculate GDP at current prices, so which is considered as a nominal GDP, and when we calculate GDP in real terms after adjusting a change in price of inflation, or reducing the inflationary effects, then it is real GDP. Or we can directly calculate real GDP through nominal GDP if we have price index or GDP deflator. We have already studied in our class how to calculate real GDP, or how to calculate GDP deflator. Basically, GDP deflator is you know um, we can calculate GDP deflator by dividing nominal GDP or real GDP. So it's a proportion. And in this slides, we can see here the difference between nominal GDP and real GDP. Actually, nominal GDP goes faster than real GDP. Yeah, this one, because real GDP, because nominal GDP has the element of prices, so that is why it goes faster. It's a kind of quadratic relation. This is not the linear relation. On the other hand, real GDP is slightly tilt, or it does not grow faster than nominal GDP. So chain rating, what is chain rating? Real GDP, basically prices change rapidly, so fixing price may give misleading results. So to solve this problem, we take chain rating. Or chain rating is it's a kind of taking the prices of preceding years. It's a kind of chain. So this measure is currently used by the official government of the US. And for example, how to calculate real GDP through chain weighting. So if say we have $300 real GDP in 2003, then quantity increased by 1% 2003 and 2% 2004. So simply we will just take the, or we will just add 1% in our earlier GDP, kind of 300 into 1.01. It's a kind of 101%. That would be 303, and 102. So it's kind of 309 in 2000, 9.06 in 2004.